Welcome to the macroeconomic analysis session for the week ending May the 15th and the week beginning May 18th. I'm David McCulloch from the Elite Traders Club, and sitting alongside me this afternoon is Jeff Saffer, head of the Elite Investors Club. Good afternoon, Jeff.
Good afternoon, Dave.
The budget released this week, weakness in the banking sector, although Macquarie Group posted some good results recently, which you discussed in your Elite Investors Club webinar yesterday. This last week's also had retail sales in the US come in, some news on China's industrial production and fixed asset investment. So let's have a look a little bit closer, but first of all, the disclaimer. The content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, or particular needs before making an investing decision based on the general advice presented in any of the Elite Traders Club presentations. You must consider whether the advice is appropriate in light of your financial circumstances, or seek further advice on its appropriateness. Jeff, last week we had the NAB Business Confidence Survey, and there was no change in that. Why do you think there was no change?
Yeah, look, I think the main reason for that is that businesses were awaiting the budget and weren't going to change their opinion on the outlook for the economy and for their own fortunes until they saw what was announced. So it's a nice lead into the next point you've got there. We had the federal budget release. It was a fairly, I guess you'd say, soft budget. There weren't a lot of structural changes announced. It was probably more notable for things it left out rather than measures they announced, and certainly a lot less disruptive than the budget that was announced last year, which was quite aggressive, I guess you'd say. In the budget overall, different obviously means different things to different people at different tax rates and etc. Ignoring sort of the personal side of things, the individuals, but more from a market, an economy side of things. Look, generally it had some measures to improve workplace participation. Also a few measures to improve business confidence and sentiment. So lowering small business tax rates, and also having some tax deductibility of some investments in the next couple of years. So that is intended to actually really boost business confidence, get businesses spending as well, and kickstart the economy a little bit. So I would suspect that whilst there weren't huge programs, I think you'll see business confidence probably spike a little bit next month. And certainly business confidence and consumer confidence took a massive hit last year on the back of the budget. Definitely won't see that this time round.
Sure. So was there anything in particular that might favour or benefit one sector of the economy?
Look, a couple of things in there. Number one, the childcare sector. So some changes to childcare funding aimed at getting more parents back to work. And obviously they head back to work, they'll put kids in childcare. So childcare operators, some good news there. Having said that, those policies are linked to some family tax benefit changes announced last year that are still hanging around in the Senate, haven't got anywhere. So even that I cast doubt over whether it'll actually get passed and get through. Outside of that, just some minor things around the edges, to be honest. Probably good for the retailers if businesses do start spending money again, and a few sort of minor specific items as well.
Sure. Okay, the next point we've got there is on the USA. We had retail sales month on month coming in at 0% versus 0.3%. 0%, Jeff, that doesn't mean that there were no retail sales, does it?
No, it doesn't. It means there was no growth, so retail sales were the same this month as last month.
Yes.
I tend to look at core numbers for these kinds of indicators. I think that was up 0.1%, but again, it also was well below expectations.
That's right.
If anything, this follows the good news, bad news paradigm that you brought up recently.
Yes.
So fairly disappointing from an economic sense, but fairly good from a market sense, because it pushes back the prospects of rate hikes in the US.
So how much does the retail spending from the consumer contribute to the US economy?
Yeah, consumer spending makes up about 70% of GDP.
That's a lot, isn't it?
It's massive.
Yeah.
So consumer confidence, employment levels, retail sales are probably more important in the US than they are I mean, they're important in every country.
Yep.
Probably outsized importance in the US.
Sure. And unemployment claims they're coming in at 264,000 versus 272, so a slight reduction in the amount of people claiming unemployment benefits.
Yep. That's fairly close, but obviously a slightly better than expected result. And the jobs market is probably the number one thing that the Fed is looking at in terms of its rate hike timetable. So very important to keep an eye on.
Yeah, sure. The next point there we've got is on China. So last week we were talking about industrial production and fixed asset investment, what that meant. Can you just recap on those 2 points, Jeff?
Yeah, look, obviously China is very much an export-oriented economy, and obviously industrial production is a major part of how well their economy is going to perform. And also, if Chinese factories are booming, it's also a good indicator for the rest of the world. It means everybody else is buying and demanding goods. So we've seen a steady decline, fall in industrial production over the last sort of half a dozen years, and we're now sitting at the lowest point lowest growth rate that we've seen since the GFC. And fixed asset investment is investment in factories and infrastructure and things like that, and long-term machinery and things like that, and that's actually at the lowest level in over 10 years.
Sure.
So this whole big growth push is obviously continuing to slow down in China, and that's just it's a very clear pattern there.
That would be, I mean, just looking at a chart as an example and seeing industrial production sort of coming down over a period of years. I mean, I would have thought that if you had something that at some stage, where industrial production was around 10% as a very high level, that surely a country couldn't continue to grow at that rate, because that would mean, using the rule of 72, that in 7 years' time, GDP or industrial output was going to be 100% on what it was at the beginning. That's a massive amount of growth for a country to go through.
That's right. And I mean, China rewind sort of 10 years, and China was putting together some insane growth numbers in terms of GDP growth, industrial production, fixed asset investment, and those numbers are not sustainable. I mean, it's interesting when we look at it that China is only, and for the audience out there, I've got the sort of inverted commas, only growing at 7%. Virtually every single country around the world would do something crazy to try and get 7% growth in GDP. It's a phenomenal number. I mean, in Australia we're looking at about 2.5%. But the 7% is slower than they have. Progressively, it's the growth is slowing down. So it's you can't continue those rates forever. You've got to come back at some stage.
Well, let's have a look at what happened on the markets this week. In particular, starting with the Australian market again. Just recapping from the beginning of the year, the highest point that we closed at, we were up around about 10.5% since the 1st of January. Since then, over a period of probably around the last month, we continued to sort of drift sideways between around 6,000 and around about 5750. Last week we fell out of that range. We broke through a support level there at around about 5750, and this week, we've been sort of drifting down a little bit lower. We've had a couple of days of upward movement in the last 2 days. Last night, overnight, obviously the US closed up very, very strongly. It would be good if our market could close back above that 5750 range on a technical basis. Again, just to show us that area of support, that was support, that we can break through above there, and that can act as support going ahead. I think if we fail to close back above that level, it's not good for our market. From a technical point of view, it would mean that old support level is now starting to act as resistance. I would expect coming in the next week, given what's happened in the States with a very bullish night last night, and you'll see that in a moment, that our market should continue to move upwards. Since the beginning of the year, again, mentioning that the movement in the index was up around about 10%, it is pretty natural for that movement upwards to pause and retrace, and that's basically about a 50% retracement of the move from the beginning of the year, and that's pretty typical of upward moving trends for retracements to come back somewhere between around 30% down to maybe even down to 60% before continuing on. So no need to panic at the moment. I think we just need to make sure that we've got our eyes on managing our risk as always. So let's go and
just on that pullback as well, Dave. I've run some numbers in the past that the Aussie market tends to pull back at least 5% every, I think it's about 60 days.
Yep.
And I think just by looking at the chart, it's probably been about a bit over 3 months. Or in fact, sort of 4 months actually, since the last sort of notable pullback, and that's probably, in a sense, if a pullback might have been overdue just from that perspective.
Yep.
Had a good run up, and you can't stay up forever.
Yeah, certainly. I guess one of the areas of weakness in the market of late, Jeff,
really the banking sector. Banking sector has driven a lot of the weakness.
Yep. Okay, well, let's go and have a look at what's happened in the US. Again, not quite so much outperformance in the US compared to the Australian market of recent. Beginning from the 1st of January, the US market, as you can see there, is up around about 2.3% from beginning of the year to now. This time last week, prices had come down a little bit on the index there. But as you can see, that last candle, very, very strong candle, a very bullish Marubozu, and really, getting up towards that 490, 492 area. And if that continues through, then I think that'll flow through to the Aussie market. But then again, we've got a raft of data coming out this next week that I'm sure is going to have an impact on our market. So let's go and have a look and see what's coming out this following week. Next week, we've got the monetary policy meeting on Tuesday. We've got consumer sentiment on Wednesday. Consumer sentiment tends to be a forward-looking indicator because it indicates what people intend to do with the finances that they've got. We've got flash PMI coming out in the US, which could be market moving as well potentially. The Eurozone economic sentiment there, I'll get Jeff to explain a little bit about this in a moment, but importantly there in China, we've got the HSBC flash manufacturing index reading coming out on Thursday, which from our point of view, the Australian market will be important, and then we've got some monetary policy statements coming out in Japan on Friday. So Jeff, in Australia, Tuesday and Wednesday of next week, what do you make of the data that's coming out?
Yeah, so the monetary policy, it's actually the minutes from the last interest rate decision a couple of weeks ago.
Yep.
So that's just really going to flesh out what's on the RBA's mind. And it's a really interesting one because when they, earlier in the month, they said, look, we're cutting rates, but basically hinted that there's no more rate cuts coming.
Yep.
A week ago, they came out with their quarterly statement, the RBA that is, and they sort of said, look, we'll do whatever's necessary. So, if the economy weakens, shows some signs, they sort of left the door open a little bit.
Mm-hmm.
So these minutes will be quite key. I mean, they're always important. I'd say this is even more important than usual to just get inside the RBA's mind and try and get a feel for how strong they are on leaving rates as they are.
Yep.
Consumer sentiment we spoke about in terms of the budget. I think you might see a little bit of a jump in consumer sentiment. Certainly nothing like the reaction we saw last year.
Yep.
In the US, obviously a couple of manufacturing indices. They've actually had some. These have been fairly strong over the last couple of years, but in the last few months we've had a few hiccups there. So I wouldn't actually be surprised to see a bit of a bounce back.
Yep.
Having said that, over in the US, the US dollar's been fairly strong in the last sort of about 11 months now.
Yep.
And that's really starting to hit the export sector in the US. So US dollar's now been weak for 4 or 5 weeks.
Yes.
That might give the manufacturing sector a bit of a boost.
Yep. Okay.
Over in Europe, this is it's not a popular indicator, but this is something that I pay quite a bit of attention to, so it's one of the most important things I think out of Europe. And what this actually does is a survey of professional investors and analysts in Germany about their outlook on the economy, and this has been quite positive. It's been very, very high in recent months. We'd probably expect that to continue.
Yep.
And it's quite a good and accurate indicator of market performance over there.
Yep, the German market, obviously, of recent over the last 6 months has been very, very strong. Over the last probably 6 weeks, it has been a little bit weak. Obviously, the Germany economy over there is one of the leading economies in the Eurozone. Some of the other countries over there at the moment, their markets are performing particularly well. The Spanish, the French market, the Italian markets are probably all being dragged up to a certain extent by Germany.
Yep.
And the overall feeling there. What would it mean if the economic sentiment came out and it was not particularly good?
Yeah, look, it's certainly not. This is not really the kind of piece of data that the number comes out and immediately the market tanks.
Yep.
It's not that kind of impact.
Mm-hmm.
But certainly it is more of an accurate. I use it in a sense as an accurate predictor. So when the number is very strong,
yep.
It gives me a good sense and a vibe for what's going to happen in the coming months.
Yep.
Certainly, if it was weak, I'd be starting to get more worried that weakness in German equities
Yes.
over the last 6 weeks would continue.
Yep.
So I think you should expect to see a number somewhere around 50 there,
Yep.
or a bit higher.
Yep. Okay. And China, the flash PMI coming out on Thursday.
Yeah, so to me this is the most important indicator out of China. This is not just activity levels, but also confidence levels, order levels, staffing levels, inventory levels, surveying factory managers in China, obviously a huge part of their economy. And this has been weak for the last few months.
Yep.
And I don't really see any reason for that to turn around. So I think you'll probably see another number below 50, which is the line in the sand between good and bad reading.
Yep.
And then in Japan, monetary policy statement. You probably won't see too much deviation from previous policies.
Mm-hmm.
They have obviously announced significant QE measures, and they're trying to get inflation up.
Yep.
At the moment, inflation's not really going anywhere, so I can't see them changing their course too much.
Yep. Yep. Okay. So there you have it, folks. A look back on the week that we've just had. And looking forward to the week ahead. Some key data coming out, so keep an eye out for that during the course of next week. That's it for this week's macroeconomics analysis session. Hope you all have a good weekend. We have already sent out the invitations to the weekly analysis session for Monday morning, so keep an eye out for that in your inboxes. But until Monday morning, it's Jeff and Dave saying goodbye. Have a good weekend, and we'll catch up with you the same time next week.
See you all.